If they were to use or if you were to use your pay stub as one of those forms of verification, are they going to look at your gross income before taxes and deductions, or are they going to look at your net income?
Generally speaking, they're gonna look at the income less you certain allowable contributions like a 401k, 403b, things of that nature. So they're not going to look at the absolute net after taxes and things like that, but they are going to account for those types of deductions, those above the line deductions that would show on a tax return. And so the way that I do it for my clients, when we apply for income driven repayment plan and we attach a pay stub, we're going to write on there the kind of the pay frequency, whether it's monthly, weekly, every 2 weeks, whatever. But then we're also going to highlight those above the line contributions through a 401k, HSA, things of that nature to make sure they get properly accounted.
Yeah, this is something that, again, we haven't talked about it on the podcast, but in terms of our one-to-one work, we've had plenty of scenarios where we have someone who got a huge bonus last year or a new grant of restricted stock that they're not going to get this year. So we tell them to use a pay stub. We've also had scenarios where maybe their spouse has, experienced a drop in pay, or even someone who has like a really large investment account that's a non-qualified investment account that's kicking off gangs and things of that nature. Hey, that might be an extra 20, $30,000 of income between that and a high yield savings account that shows on your tax return but doesn't show on a pay stub. And so it's definitely something that we often recommend.